Yeah, thank you. And this is part of a series. We have another one coming up next week to round it off, in which we're going to talk about employee share ownership programs. But today, we're going to talk about the term sheets. I do have to say that I am not a lawyer. None of it should be construed as legal advice. What I'm going to go through is basically talk about the terms so that you can have an understanding of the logic and what they mean, and basically decoding some of the legal language around it. First, let me kind of introduce Indelible Ventures. We are a seed stage venture fund focused on tech-enabled B2B products that can scale internationally. We're actually a US domiciled fund, but we're focused exclusively on Malaysian startups. My name is Kevin Brocklin. I'm the managing partner. I'm also the general partner. My background is entirely in fund management. I've managed over 500 million in assets, worked with some of the largest institutional investors, worked directly with hundreds of companies across continents and across countries. I've had visibility into hundreds more. I've looked at and not invested in many hundreds more than that. So a lot of broad exposure. I've helped many companies scale internationally as well. So a lot of deal experience over the course of my career thus far. And so, yeah, the goal for today is understanding the term sheets, and it's really about kind of decoding, because if you're like me, legal language doesn't come naturally, and so there's a bit of decoding of what the what and the why of the common terms that you'll find in your term sheet. So hopefully, kind of the takeaway out of this is that when you guys do go out and fundraise and receive your first term sheet, you'll be able to look at it and understand what you're getting into, as well as have an understanding of how to negotiate and where you can negotiate. There's many times where I've gotten involved in investments, or I've seen investments done elsewhere, where founders agree to terms without fully understanding them, simply because money's on the table, and hey, somebody's willing to invest $1 million in me. Yeah, I'll say yes, 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 because I need to grow my business, without necessarily fully understanding everything about the terms. So first off, there's, by and large, term sheets are not always going to look the exact same, because different investors will have different layouts. But I'm going to talk in general terms. And generally speaking, you're going to have two sections of a term sheet. You're going to have the binding provisions, and then you're going to have the non-binding provisions. So the binding provisions are like your confidentiality agreement, so that you can't just share that term sheet around. There might be exclusivity. So if you agree to a term sheet, there might be exclusive that you can't negotiate with anybody else for 90 days, whatever, some sort of time frame. It should specify out what's the applicable law in the jurisdiction. It may not always be Malaysia. It sometimes could end up being Singapore, or having the Court of Arbitration in Singapore. So not hugely challenging, but just something to kind of understand. There's some miscellaneous other things that could end up being thrown into there, but most things that get tossed into the binding provisions, besides confidentiality and exclusivity in the jurisdiction, are generally not very consequential. Okay, so then moving to the non-binding terms, which this is really the meat of the agreement. This is the core components. And so I'm essentially going to divide this into kind of four types. You have your economic terms, you have your governance, your shareholder rights, and then you'll have miscellaneous other provisions that are inside of there as well. So let's start off by talking about the economic terms. And so the first thing to really tackle is, what is the instrument that the investor is coming in with? And there's many different types out there. I've taken four common ones here. And so I'll give you a little bit of description about each of these. I imagine that people are pretty familiar with them, but I'm just going to kind of do a quick overview. And so your common equity is basically the shareholding that doesn't have any special ranking or rights. The rules that are associated with the rights of those are basically in the Company Act or other national or whatever the jurisdictional law applicable is. By and large, when you get to an institutional venture capital firm, they're not going to invest in common equity. Angel rounds may, crowdfunding may, but generally speaking, when you get to a VC fund, they're not going to invest in common equity. This is something that is generally done prior. Aside from that, you have preferred equity, and this is shareholding that does provide additional rights and protections for the investors. So when I talk about all the economic terms that you see in the term sheet, if it was common equity, it would be a pretty short term sheet because there's not really any terms that you can add into it other than the price paid. Preferred has a number of different ones, and I'll get to those as we go through this. But essentially, preferred equity is having preferential rights, hence the name preferred, but it'll have some sort of conversion to where the preferred will convert into common. Oftentimes there's triggers such as if you IPO, the preferred will automatically convert into common because that's some of the rules around public exchanges oftentimes. Or if there's an acquisition, then the preferred can end up converting over and so forth. On the hybrid type of investment, you have convertible notes. And so this is a debt instrument that's essentially a loan that will convert into equity. And so sometimes that may be structured as it's a compulsory conversion into equity so that the debt side of it is actually limited. But generally the debt features will stay intact where there's an interest rate, generally low. There's a maturity date. Oftentimes the maturity date is set relatively short because the intention is to push you towards raising additional rounds of capital. And then I'll talk about valuation here in a second, but I'll leave that for the next slide. I'll come back to it, but generally it converts into preferred equity because again, in general terms, venture funds are looking for preferred equity because even afterwards they want to maintain some of those preferential rights because when you think about it, the founders are creating the idea. Sure, they're putting their sweat equity, but large sums of capital are coming from venture funds in order to accelerate the business forward. And the venture funds see it as, since I'm providing this risk capital, I need some preferential rights that can kind of protect the risks associated because you're in the driver's seat. And so you have all of the control. And because the control's with you, I need some terms included into this that provide me some risk controls as well. Okay, so then the next is something that's not extremely common here in Malaysia, but is becoming increasingly common in many parts of the world. Initially, Y Combinator came out with it, and you see it more and more often in Singapore and India and some other ecosystems that are a little bit more mature and have a little bit more capital coming into it. It's really neither debt nor equity. It's a simple agreement for future equity. It's basically a contract saying that when you do issue it, then it has a lot of the features of a convertible note, but it doesn't sit on your balance sheet, which is a problem that many companies face because of a number of different factors, whether it's like insolvency provisions that governments have in relation to what your balance sheet looks like. Some companies struggle in order to get certain contracts because there's the large contracts. They look at what your long-term solvency is, and they do this analysis on your balance sheet. So there's There's implications around using convertible notes. There's implications around using safe notes as well. From the investor side, there's actually, a lot of the enforceability of a safe note is it's not as safe as it seems, in order to play a pun on the words. But it's a common type of agreement that likely will end up becoming increasingly common in Malaysia as it has elsewhere. So it's something to be aware of that could come across. Okay, so probably one of the most important parts of the term sheet that everyone zooms in on is understanding the valuation. And so the two basic terms that you need to understand is first the pre-money value, which is the company value prior to investment, and the post-money, which is the company value post-investment. Essentially, pre-money plus investment equals post-money. All right. And so I'm just going to do two quick examples here in this. I have two quick examples on this table. When you get further down the road, so I think it's important to note that your ownership, your cap table, can get more complicated over time. And so when you start including safe notes and convertible notes and preferred equity, it can get pretty complicated. So it's very important to stay organized and on top of it and have a good way of managing it, whether you're using a third-party service, which there's many third-party services that do that, or whether or not you're doing it in-house. It's very important because when you do go to raise capital, you need to be able to say what your ownership table looks like, your cap table, on undiluted basis and a fully diluted basis, meaning as it stands versus on an as converted basis. If all preferred equity, convertible, safe notes, if all of those ended up converting, you need to be able to say what it looks like. So anyways, valuation. So let's imagine you have this cool company Z, and then you have the next company B. And each of them have, 1 million shares outstanding at $5 a share, giving a pre-money value of $5 million. And that there's the main difference is the investment amount. What's the impact? Well, pre-money is the exact same. The post-money ends up being different, and how that plays a role into it is how much equity are you giving up. So when you look at the investor share out of this investment, Cool Company Z is giving up 16.7% of their shareholding. Next company B is giving up 28.6% of their company. So the main thing to consider is that some companies go out and say, hey, I just want to raise as much money as possible. But you need to have in mind as well that you need to raise an appropriate level of capital, because you also need to think about how much you're giving up of your company. So maybe next company B had the exact same funding needs as Cool Company Z, but now they've given up a much larger share of their company. So then when they go for their next fundraise, they own significantly less. Maybe they could have gotten better valuation for that second $1 million if they would have waited 12 months in order to raise it and kind of split it into separate rounds. Then they would have given up a little bit less. So I think that's the key consideration here when you're thinking about valuation, is the trade-off of cash today for the ownership versus cash tomorrow for perhaps a better valuation. And having a strong understanding, as we talked about in prior sessions in regards to the business financials, of what your true cash needs are, and being able to have a little bit of a cushion on top of that, just in case things end up happening. But it's important to understand the balance of this and how much you're giving up. And another point on it is that investors generally operate in rules of thumb in regards to what percent ownership of founders or within the company, because oftentimes employee share ownership gets added into that. How much of internal capital of the shareholding is held, and how much is outside by investors and angels and so forth. And as you'll see, if you start dropping below that sort of rule of thumb, it becomes more difficult actually to raise subsequent rounds of capital. So it's very important to have that in mind when you're looking at your term sheets. So the conversion, as I said on the convertible note, so there's really two factors that are going to be included into here. One of them is going to be the discount, which is basically saying what's my discount to the next round's share price, and a cap. What's the maximum valuation that I would end up converting at? So then if we look at this and say, okay, scenario A, scenario B, and C, that I have a 10 million cap and a 20 million discount. And so if I have a pre-money value of 10 million, I'm converting at the 20% discount, which is 8 million. If I have a 12.5 million pre-money, 20% discount on that brings me back to the cap at 10 million. So that's kind of the break-even point on the valuation between discount and cap. When I go above that, I sit at the cap. So for example, at a $20 million valuation, I would convert at 10 million. So it's important to kind of have that understanding. Oftentimes when an investor sets the valuation cap, they're setting it at what's the maximum that I would be willing to pay today, generally speaking. Sometimes there's a little bit of a trade-off between having a bigger discount versus a higher cap. But that's one of those things to where you need to have an understanding, and perhaps when you get the terms from an investor, put a table like this together to where you can see what the conversion value is and what the impact would be on that shareholding, so that you have a clear understanding of what does this mean in the economic terms of not only what the pre-money is, what the conversion value is, but also what's the impact on the percent ownership that I would be giving up. Also on the economic terms is going to be an option pool. This is the employee share ownership. When you start getting into institutional venture capital rounds, generally speaking, they're going to insist on setting aside a percent of the shareholding of the company for employees. What that percent is could vary. Sometimes it's 5, 10, 15, 20. It really depends. I've just recently done one where I said 10% is the number that I wanted, and knowing that, as the company progresses, it'll get topped up and we'll have to keep on increasing that pool over time. But also something to understand in regards to what the existing shareholders, what the impact's going to be there. So let's take this Cool Company Z and Next Company B example that I did earlier, where the investor was putting in 1 million or 2 million, where it's 16.7 and 28.6% respectively. And let's say in the terms that they said that the company needed to allocate an option pool of these respective sizes. What's the impact on the shareholding? So as we recall, we had 1 million shares amongst the existing shareholders. Let's call those the founders. We had additional shares allocated to the investors, the 16.7 and the 28.6. We're going to get a post-money 15% and 20% respectively. And so when you add those all up, the existing shareholders, the founders, now have 68.3 for Cool Company Z and 51.4 for Company B. And so it's important to understand that not only did this new money come in, but an allocation of an ESOP pool gets set there as well. So it's going to be very important for you to understand that. Now, mind you, like I see some founders get really obsessed about the percentages. But keep in mind that, this is a company that now got valued at 5 million, to where, the founder in Company B, post money is 7 million. So they actually are valued at having basically 3.5 million worth of equity. As the company grows, that value is going to grow. So it's one of those questions of, you know, when you're looking at bringing new capital in, do you want to own a large piece of something smaller, or you want to own a smaller piece of something much larger? And oftentimes that's where it comes down to when you're putting in additional capital. So don't understand what the impact of your own dilution is, but keep it within reason that eventually over time, if the company is successful, you're going to be diluted to a smaller and smaller percentage. And if you look at any of the main unicorns, like use Grab for an example, since that's one of the most recognizable names, their percentages have now gone down to relatively small. When you look at like some of the Silicon Valley companies as well, like eventually by the time they go public, their percentages are quite small. Some of them end up getting these crazy shareholder rights and golden shares. I'm not going to touch on that here. But dilution will happen. I just want to make sure that I'm highlighting the math here so that you do it yourself when you get a term sheet, so that it's very clear to you what your shareholding is. And I would also encourage that you kind of forecast what your shareholding is going to be over the next couple of raises. So if you're raising a seed round and say you're raising $1 million for it, look forward and say, okay, what's my Series A, what's my Series B, so that you can understand the evolution, because it makes it a lot easier in order to make the decisions of today when you're doing it while planning for tomorrow. Okay, so the next one, which is a little bit of a difficult one for people to understand, is liquidation preference. And there's two types here. I'm only really going to talk about one, because there's participating, which if anybody puts it into your term sheet, just tell them no. And there's non-participating. And so the difference is that participating basically says, I have a minimum threshold of my return, and then I want a percentage of everything above that. So let's hypothetically say that, you know, I put in $20 million and then the company liquidate, and that gives me 50% of the company. So then it says, okay, if I have participating liquidation preference, I get back my 20 million if you sell for 40 million, and then I get half of everything above that. And so I even got more than my 50% ownership. So there's ways that some investors will use participating in order to enhance their returns, but it's becoming non-standard. So what's common and what you should end up seeing and should not be so worried about is that there's non-participating. And this basically says that I'm not participating beyond a certain point. I am taking the greater of. I'm getting preference if there's a liquidation event, and it's not saying it's bankruptcy. By liquidation, they're saying any cash realization. So if the company goes public, if it gets acquired, or if it goes out of business as well and liquidates, all of those are liquidation events. And so in the event of that, what non-participating says is that I as the investor, I'm getting the greater of the proceeds, my investment, or my percent ownership of the entity. And it's one or the other. It's not a combination thereof, where participating is actually a combination thereof. So let's take this hypothetically and see and understand how the math works out a little bit on this, because it's a little bit of a complicated concept. So imagine you had a seed round, 1 million turned into a post money value of 5 million. You did an A round for 10 that gave you a post money of 40. You did a B round of 20 that gave you a post money of 100. Now, so your share percent ownership is what we see in this table. Initially, that A round gave me 25% because 10 out of 40, but then I got diluted in the B round. And so now it's 20, 20, 12, 48. And so let's do the hypothetical on what happens, because generally speaking, most of them are going to be 1x non-participating. So do factor that in. I didn't mention that, but generally it's 1x non-participating liquidation preference, which that 1x is only 1 times my money. Is the threshold amount on my preference. So let's take a hypothetical scenario and say that the company sells for 30 million. Okay, well, great. Like, you know, you started this business a handful of years ago and the company sells for 30 million. But wait. You raised a bunch of money. And so now the B round has liquidation preference above everybody. So they get their 20 million back. The A round has liquidation preference as well. So they get their 10 million back next. And then there's nothing left for anybody else. And so, while it sounds nice that there's this $30 million exit, in actuality, the founders didn't get any money back because of how much money they raised, and because this actually comes much below the valuations of prior rounds. This is technically not a success from the founders. This is the investors getting a little bit of money back, and it's honestly, it's not a bad thing. I mean, these are standard terms for a reason, because this is an event where something ended up going wrong. Let's take the hypothetical scenario of where it ends up selling at 50 million. So 50 million is still below that big B round, but at least it's above all of the capital that was acquired. So 50 million, 20 million of that is going to go back to the B round, which is above their 20%. Their 20% would have been 10 million. And so they get their money back. The A round just hits the mark where they get their 10 million back. And then the remainder is split up proportionally amongst the seed round and the common shares. So the seed round is getting their 12% and the common shares are getting their 48%. So out of that, of the remainder, so out of that, I should say that when I said the 48%, it's of the remainder after those tiers of the process. So that's how that one would function. Let's move ahead to say you sell at what that post money of 100 million is, and that's when finally the common shareholders get their actual percentage back. The break even is actually slightly higher. This is just for example purposes. But now you can kind of see and understand that when you see any news about an exit, or when you're planning ahead for your business, you can have an understanding of, okay, well, assuming that each round had liquidation preference, you have a little bit more of an understanding of the way that this actually, the waterfall, as we call it, plays out, of where the different rounds of investors are able to recoup their money. And actually, when you look at these rounds of investors selling their shares as part of an exit, people do actually value in secondary markets the B round shares higher than the A round shares, higher than the seed round shares, because of this waterfall effect as well. Because there's a difference in how the effects of a payout would end up being. But a very important one to know. I think main point out of this: participating, don't take it. Non-participating is standard. 1x is standard. If that's in it, that's perfectly fine. It's a standard term. It's not really something that's generally open for negotiation, but it's important for you to understand how this works out from a math standpoint in a future scenario where you make an exit. Anti-dilution. So there's really two main ways that people do it here. There's the full ratchet, which don't agree to this. Just throwing it out there, don't agree to it. It's not very founder friendly, and it's overly punitive. The more common one, which hopefully you will all see in your term sheets, is a broad-based weighted average. And basically what this means, and how I've listed this out, is like full ratchet says, no matter the size of the next round, I'm getting an adjustment on my shares based upon I'm getting anti-dilution adjustment on my shares based upon whatever the next price is. So you can see here with the example that There's 10,000 shares outstanding, in round one, a million shares were sold at one buck per. So it was a million shares. Fast forward a little bit, and maybe there were some troubles. Maybe something ended up happening. Maybe COVID hit, and you had to just raise a little bit of money in order to survive. And so there's light at the other side of the tunnel. And so you sold 500,000 shares at half the price, at 50 cents per. Well, if that round one had full ratchet anti-dilution, that would entitle that investor to have that 1 million investment adjusted to the number of shares based upon the 50-cent price, which means that the company would need to issue them, that round one investor, another 1 million shares. Now, the other scenario here, the broad-based weighted average, is something that it's taking into account how many shares and what the price was, so that there's a little bit more weighting in regards to the real relevance of how much money was raised at a lower valuation. It still requires some adjustments, and I'm not going to go through the whole math formula here, but the point is just to highlight the additional shares to round one. Full ratchet is very punitive because it doesn't take into account the significance of what the down round is. Broad-based weighted average takes it into account. You still have to issue additional shares, but because it was so small, the amount that you raised at a lower valuation, it's just a small adjustment of 22,000 shares. So yeah, the key point here, anti-dilution is going to be very common. Don't do full ratchet. Broad-based weighted average is the common, and that's perfectly fine to include into it. So some other economic terms, redemption rights. This is pretty common here in Malaysia. I have honestly not seen it anywhere else. I hear a lot of founders come to me and say, hey, this is basically putting a debt burden on the company, and they're not very keen on it. From my understanding, to be honest with you, because it's not registered as debt, the redemption right is not actually registered as debt. The enforceability of it is actually pretty limited on behalf of the investor, which in my personal opinion kind of brings into question why even have the term in the first place. I'm sure there's an origin story around it. I just don't see it, and it's not common in other markets, so I don't use it personally. And if you have an option, then to me, it just doesn't really make a whole lot of sense. But again, it's pretty common here, and at least from my understanding, the enforceability is relatively limited, but it's something to just kind of validate that with a legal counsel. But I get the aspect of not wanting to have something that could potentially be a cash payment burden on behalf of the company, and that's quite clear. Put options is also a debt burden on the company, and because it's basically saying that the investor can put shares back to the company and force a payment. I am not a fan of this. I think it should never be considered a standard term. I think it's oftentimes used in a predatory manner that I am not personally a fan of. I have, however, used put options in rare instances, but it's oftentimes a way in order to balance perhaps giving a higher valuation and being able to control some of my downside risk when a company is negotiating up other terms in order to offset some of the things that they're trying to take from me by putting this as a balancer. But it's in my honest opinion, it shouldn't be considered a standard term, and it's not favorable for a company. It's not something it's going to be something that's looked at very unfavorably by a next round's investors. Ratchets, basically what this is saying is that it's similar to anti-dilution. It's basically saying, but it doesn't necessarily mean that there's a fundraise or otherwise. It could be linked to performance, to where, say for example, you convince me to value you on a forward revenue basis. If I think that's a stretch, I may end up putting in a ratchet that says, if you miss this, then my shares are adjusted for, 5 percentage points for every 5 percentage points you miss on your target. So that my multiple of your forward revenue would stay the same, but then the amount of shares and the valuation associated with that gets adjusted based upon what the actual results end up being. Not an extremely common thing, but again, this is something that gets put in there in order to find a middle ground around valuation. So not common, but yeah, it's something that you may encounter. It's something that I've used in the past. So let's see, some shareholder rights. So tag along, drag along, preemptive rights, exit rights. These are kind of the core components of it. So at a high level, what the tag along rights get to is basically saying that if somebody ends up selling a certain percentage of of their shareholding, if a certain percentage of the shareholding of the company is sold, I have the right to tag along and be part of that sale. So generally, it's pegged at different percentages. So that percentage could vary depending upon the term sheet. So that percentage is likely the main thing that could end up being negotiated if you wanted to get into it. But oftentimes it's said it's something that's considered meaningful on behalf of the investor. So it could be 25% of the company. It could be 50% of the company, saying that if control of the company is sold, then I want to tag along so that I can realize an exit if a controlling stake is sold. Drag along is basically the reverse of that. So where if I've negotiated a sale or a group of the investors have negotiated a sale where a certain threshold amount, again, a certain percentage of the company is being acquired or is desired to be acquired, then we can drag along other shareholders and force them to sell as well. So for example, if I set the drag along at somebody wants majority shareholding, they want to buy 75% of the company, or they want to buy the whole company. If we have the drag along rights pegged at say 51%, once the acquisition goes above 51%, we can drag along the other shareholders in order to facilitate that sale. So those are really on the exit side. The exit, that sets the basis for some of the exit strategy. Oftentimes for me personally, I put in language on saying kind of like best efforts basis. Fixing it in that there's certain things that will happen after a certain number of years, and that it escalates to where eventually the drag along could end up becoming more punitive. Not necessarily punitive, but the threshold for drag along could end up changing the longer it's been without an exit. So oftentimes there's something along those sort of lines. The preemptive is basically saying that you have the right to participate and invest in further rounds. So if I own 20% of the company and have preemptive rights, it means that the next fundraising, I can buy 20% of I have an allocation of 20% of that round so that I can maintain my shareholding at 20%. Some governance aspects, we're almost done here. So some governance aspects that you'll likely see in it. Board of directors, depending upon the stage that you're at, the investor may or may not ask for a seat on the board. They may ask to be an observer, saying that they can attend. They may ask to actually have a full-blown position. It'll likely stipulate out what the meeting frequency is, what reserve matters are for the board of directors, if there's any subcommittees, regular reporting, those sort of things. I frequently look for a board seat because, Indelible is a value-add investor. So that's something that we look at, where we think that we can add value. Voting rights, as I said, some founders in some companies have very high voting rights relative to their percent ownerships. But oftentimes that'll get laid out in the term sheet or definitely in the shareholders agreement. If you have preferred equity or convertible notes, it'll talk about what the voting rights are. It'll generally say that voting will be done on an as converted basis so that the voting rights are there for them. You'll have information rights, which will basically stipulate out the type of information that you have to give the investor, the frequency, and also inspection rights to where they can pop by your office and check for themselves. But generally for me, I like to be pretty involved. So I look for a pretty good frequency of information, but I also don't want something that somebody's just creating something specific for me. What I look for generally is, and I only want to see information that the management team themselves find useful. I don't want something that's specifically created for an outside investor. So that's something to work out and negotiate when you get to that point. Lastly, here are reserve matters. This is basically saying that these are decisions that require the explicit approval of the investor. Some reserve matters will be put to board decisions that are required by the board, but oftentimes there's going to be some items that require explicit approval of investors. I've taken a snapshot here of an example of a handful of them. Most of them are things that impact the companies themselves. So like change in the nature of the business, changing provisions of the charter documents, the company constitution, changing the rights and preferences of preferred stock or any series associated with the investment, that the company can't do that without my approval. Or create new classes that have privileges senior to them, or amend a stock option plan, or create a new one, or authorize a lien against shares, or a lot of things that could challenge or have negative consequences for the investor will oftentimes be put into the reserved matters. Sometimes you'll see things in there like cannot take on debt above 100,000, cannot approve increases in spending beyond the annual budget greater than 50,000. Sometimes you'll see things like that as well, so where you'll be restricted on some level of spending so that it constrains the ability to kind of run away from the budget. So that it gives a little bit stronger governance to it. Some last things that I'm going to just toss out here that you'll likely end up seeing is most favored nation clause, which is basically saying if you give anybody else better rights, you have to offer it to me as well. Monitoring fee, the bigger the company you are, sometimes people will charge you a fee, say 1% of the transaction value, in order to cover the cost of monitoring the transaction. Expense reimbursement, legal expenses are often covered by the company. So there'll likely be some sort of expense reimbursement for the legal costs associated with doing the investment. And then lastly, there's a validity period because the term sheet will only be valid for a certain number of months or so on, so that it gets acted upon more quickly. And that is it. So I thank you all. If anyone wants to get in contact with me, my email is kevin@indelible.vc.